Welcome back to the deep dive. Today, we are cutting straight to the core of Europe's high stakes transition to electric vehicles.
Hmm.
This isn't just a simple industry shift. I mean, it's a topic that's really riddled with an industrial paradox.
It really is.
You see this massive record breaking market growth and adoption, but that success sits right alongside what many experts are describing as existential strategic threats.
And that's the tension we're navigating. Our sources today, a fantastic stack of industry analysis, policy papers, all of it, they reveal this dual reality.
Right.
We're going to analyze the market surges, consumer behavior, but I think most importantly, we're looking at the urgent policy response coming out of Brussels to combat these external pressures.
Specifically, the battle for control over the hardware.
Exactly. The most crucial piece of hardware, the battery.
We have to start with the sheer scale of the change because the growth is it's undeniable. It sets the stage for how aggressive this transition really is.
It does.
We learned that battery electric vehicle, or BEV registrations, increased by a colossal 38% by October 2025.
And that 38% growth, it translates to 1.47 million units sold
1.47 million.
in just the first 10 months of the year. To give that some context, BEVs now command 16.4% of the total European market share.
Okay, so this isn't a niche anymore.
Not at all. And if you widen the scope to include the UK and the EFTA nations, that total climbs over 2 million vehicles,
Wow.
hitting 18.3% market penetration. This is officially entering the mass adoption phase.
Okay, so let's unpack those record numbers. We saw quarterly sales nearly hit 600,000 units in Q2 2025 alone. What specific levers are pushing this market acceleration?
It's largely a combination of price accessibility and infrastructure maturity.
Right.
Our sources clearly indicate that sales are being boosted by the introduction of more economical EV models. The established European players like Stellantis and Renault are finally hitting lower price points.
But that's not the whole story, is it?
No. Critically, we're seeing increasing penetration of Chinese vehicles like those from BYD, which are just aggressively competing on price and availability.
And as we know, for the average buyer, that emotional hurdle of will I make it to my destination is often bigger than the sticker price.
That's right. And the continuous, visible expansion of the charging network is actively reducing that range anxiety.
So perception is improving.
Exactly. The network isn't perfect everywhere, but the perception is improving. And that acts as a major psychological catalyst for non-owners who are thinking about the switch.
What's fascinating, though, is how fragmented this picture is geographically. The overall European average is strong, but the pace of adoption is just wildly uneven.
It truly is a story of disparate markets. You see absolutely explosive, almost unbelievable growth in parts of Eastern Europe. Poland, for instance.
I saw those numbers.
They reported an increase of nearly 320% in registrations.
320%.
And Slovenia was up over 208%. These numbers show markets rapidly catching up from a lower base, but the commitment is clear.
But then you have these huge legacy markets that are, well, they're lagging.
Precisely. Italy, a core EU automotive market, remains well below that 10% adoption threshold. It clocked in at only 4.9% market share in August.
And you compare that to
Nations that have already hit critical mass, like Denmark, where EVs reached 51.3% of new sales,
over half.
over half. Malta at 37.7%, and Sweden at 34.9%. Those leading countries really show what happens when policy and consumer sentiment align perfectly.
Let's talk about that consumer sentiment because that dictates the market ceiling. Do Europeans actually want these cars, or are they being, forced into them?
For the most part, they want them, and they recognize the benefits. About 57% of non-owners surveyed say they would consider buying an EV.
And what are they citing as the reasons?
Benefits in climate mitigation and greater efficiency. However, the data is crystal clear on the single largest barrier.
I think I can guess.
It's the price. Two-thirds of interviewees cited the high initial purchase price as the main deterrent.
That sticker shock remains the biggest hurdle, which means policy isn't just about infrastructure. It has to directly address that initial cost.
It does. And we're seeing policy efforts that are becoming more and more sophisticated to smooth out that cost curve. Take France, for example.
The ecological bonus.
They extended their famous ecological bonus scheme into 2026. And what's interesting is how they've tailored the incentives.
How so?
They're targeting them specifically based on the vehicle's sustainability criteria.
Yeah.
So where it was made, how clean the process was, and also the applicant's income level.
I see. So the support goes where it will have the biggest effect.
Exactly. The maximum accelerating effect on zero-emission mobility.
Those growth numbers, they paint a rosy picture of adoption, but they mask that foundational problem you raised earlier, the external threat. And that brings us neatly to Section 2, the China challenge. We have to start by acknowledging the scale of the risk here. The automotive sector contributes a massive 7% of the EU's GDP.
And supports nearly 14 million jobs.
14 million.
That makes the industry far more than just a sector. It's a pillar of the European economy. And that pillar is now squarely facing the China challenge.
It's not just competing anymore.
No, China is firmly established as the world's leading EV producer, accounting for over half of global production.
How did they achieve that dominance so quickly? I mean, what's the secret sauce there?
It stems from deep, prioritized state subsidies across the entire manufacturing pipeline. Also, strategic access to and control over natural resources, and of course, a massive internal market.
Which allows for economies of scale.
Staggering economies of scale, far beyond what European companies can currently do. And this allows them to export competitively priced vehicles globally.
And Europe, as a massive, wealthy, and, relatively open market, has become the primary destination for those exports.
Exactly. Europe has become China's largest EV export market, and this creates a severe, multifaceted challenge.
Okay, break that down for us.
First, Western manufacturers themselves are increasingly shifting their own EV production to China, which risks offshoring intellectual property and jobs.
And the second part?
Second, Chinese firms are targeting European consumers directly, which leads to potential economic vulnerability and an overdependence on Chinese technology and supply chains.
So if this is an existential economic threat, what was the immediate European policy response? The EU couldn't just stand by.
It couldn't. This required direct market-level action. The European Commission launched an anti-subsidy investigation in October 2023.
Right, I remember that.
And this was specifically aimed at proving that Chinese EV makers benefit from state support that gives them an unfair competitive edge.
And that investigation led to tariffs. What was the outcome?
The investigation concluded that, yes, unfair subsidization was occurring. This resulted in the imposition of definitive duties, or tariffs, ranging from 17.4% up to 38.1% on Chinese-made EVs.
And those are set to apply by late 2024.
That's right.
Wait, so we set tariffs up to 38% to protect our existing industry. But isn't there a side effect here? That the policy might actually be building Chinese-owned factories inside Europe to avoid those duties.
That is the complex trade-off that policymakers are struggling with.
It seems like trading one dependency for another.
It could be. Experts are quick to caution that tariffs are merely a temporary measure. They buy time but don't solve the underlying gap in industrial competitiveness. And yes, they ironically incentivize Chinese EV manufacturers to make massive direct investments inside the EU.
Which, on one hand, creates jobs.
It technically creates local jobs and knowledge transfer, but it means key industrial capacity and potentially technological control still rests with foreign entities. It's a very, very tricky balance.
So if the threat is competition and the immediate response is tariffs, the foundational weak spot is the hardware.
It always comes back to the hardware.
Let's pivot to Section 3, because the real strategic challenge is control over the battery, which represents anywhere from 25 to 40% of an EV's total cost.
The EU needs a resilient, homegrown battery ecosystem, but the sheer scale of the manufacturing challenge is, well, it's colossal.
Just how big a gap are we talking about?
China dominates the entire supply chain, from raw materials processing to cell manufacturing. Globally, China accounts for over 80% of battery cell manufacturing capacity. The EU currently hovers around a mere 5%.
And the sources show the dependency is even more acute when you look deeper into the components needed to build those cells.
Absolutely. The material chain is almost entirely outsourced. China holds nearly 90% of the global capacity for cathode materials, the positive side of the battery, and an astonishing 97% of the capacity for anode materials.
97%.
For those critical, high-value segments, Europe currently has almost no meaningful manufacturing capacity.
This dependency makes the next point even more concerning. This brings us to a case study that truly shocked the European industrial world, the collapse of Northvolt. This company was supposed to be the model Europe's flagship battery builder.
It was hailed as the cornerstone of European industrial self-reliance. Northvolt, despite securing an incredible $15 billion in funding,
$15 billion?
it ultimately filed for bankruptcy in November 2024. To burn through that much money and still fail implies a problem far deeper than just market competition.
So what did your sources say was the fatal flaw?
It wasn't just one thing. It was a destructive cocktail of issues. Primary factors included poor management, a reported over-reliance on sophisticated Asian machinery that proved difficult to operate,
I see.
and persistent, unresolved technological issues when trying to scale up high-volume, cost-effective manufacturing.
So that failure didn't just hurt one company, it cast a shadow over the entire European strategy.
Precisely. According to the analysis, this event raised serious concerns about the technological and managerial viability of establishing batteries made in Europe at a competitive scale. It just underscored how far behind the EU is in that fundamental manufacturing know-how.
And that failure is reflected directly in the current cost disparity.
The data is inescapable. Li-ion battery pack prices are currently 40% higher in Europe,
40%.
around 163 per kilowatt hour, compared to a much lower euro 116 euro per kilowatt hour in China. That massive price differential is the industrial gap Europe needs to close, and fast.
So faced with this reality, how is the EU deploying industrial policy to solve this? We hear a lot of acronyms, NZIA, CRMA. Let's break down the big instruments being used.
Okay, the overarching objective is encapsulated in the Net Zero Industry Act, or NZIA. That sets a non-binding goal of reaching 550 gigawatt hours of EU battery manufacturing capacity by 2030. The ambition is high.
And to support that, you have to secure the materials and provide cash for infrastructure.
Exactly. So they've launched the Critical Raw Materials Act, the CRMA, to secure supply chains for those vital minerals. Then you have major financial instruments like the Alternative Fuels Infrastructure Facility, or AFPI.
Right.
That's granted over 600 million euros specifically for charging projects to speed up that network deployment.
And then we have the IPCEIs. Before we move on, for those unfamiliar, could you give us a quick one-sentence context for what an IPCEI actually does on the ground?
Sure. An IPCEI is basically a massive EU-level project that lets national governments fund truly innovative transnational industrial projects that would otherwise be too risky.
And that leverages private money.
It leverages billions in private investment to support technologies like battery R&D and manufacturing scale-up.
So the ambition and the money are clearly there, but the projections show a contradiction. We have massive announced capacity, yet the risk of dependency remains high. Why is that?
Well, announced gigafactories could reach up to 1.3 terawatt hours by 2030, which on paper is well over the projected EU demand. But this relies on the rapid, successful acceleration of construction and scaling, something Northvolt failed to do. The fundamental contradiction remains. The reliance on foreign manufacturing for key components means there is a high risk of serious dependencies at that component level.
Especially for cathodes and anodes.
Especially, even if the final assembly is done in the EU.
Let's pivot now to Section 4, because there is a bright spot for the consumer buried in all this. While the purchase price is a major barrier, the overall cost of ownership offers a huge advantage. What's happening with the price of charging itself?
This is where Europe's clean energy transition starts paying massive dividends for EV owners.
Okay.
The price per kilowatt hour in Europe is expected to fall, and that's due to the massive increase in generation from solar and wind energy. When renewable energy is abundant, it drives down marginal energy costs.
And that favors EV owners how?
It naturally favors cheaper off-peak and nighttime charging for EVs, which dramatically lowers the operational cost of the vehicle.
So despite the high sticker price, the overall financial benefit is undeniable.
It is. Studies confirm that the total cost of ownership, or TCO, for EVs is already up to 75% lower than comparable combustion cars,
75% lower.
especially for high-mileage users. Driven by this accessible, cheaper, renewable energy, a typical family could potentially save up to $1,600 annually on energy and maintenance.
And finally, there's the slightly counterintuitive benefit. EVs might actually make our energy grids more stable, not less, even with rising demand.
That's the potential of vehicle-to-grid, or V2G technology.
Yeah, right.
While more EVs obviously raises overall demand, the batteries themselves, when plugged in, can act as decentralized storage units.
So they can feed power back in.
They can release power back to the network during peak demand hours, effectively helping to shave off costly peaks. The flexible nature of EV charging allows the entire system to manage renewable energy and consumption shifts much more effectively.
This has been a deep exploration into a very tense and dynamic situation. So, to summarize that core tension, Europe is leading global EV adoption in many respects, successfully investing billions in infrastructure and announcing massive manufacturing capacity. Yet the industry remains acutely vulnerable to external competition and supply chain risks.
A vulnerability that was dramatically underscored by the collapse of a domestic champion like Northvolt.
The strategic choice facing Europe is clear and immediate. The European Parliament study we looked at outlined four possible future scenarios for the industry by 2030.
And they essentially boil down to two poles of risk. On one side, you have cutting-edge Europe, where the EU manages to close that industrial gap and lead global innovation.
And on the other,
On the other side is slow electrification, where the European market is just dominated by Chinese exports and localized foreign production.
so that's the question we leave you with today. Considering the massive dependency on battery components and the clear recent failure of a major domestic player, which of these paths leading global innovation or struggling against foreign dominance requires the most immediate and strategic focus from policymakers right now?
The decisions made today, whether to prioritize fundamental material security or accelerate risky cutting-edge innovation, will define the future of those 14 million jobs and that 7% of European GDP. It is the industrial choice of the century.
Thank you so much for bringing us all this amazing material and for letting us conduct this deep dive into your submitted research.
My pleasure.
We hope this gave you a perfectly clear shortcut to being well informed on this critical topic. Be sure to follow the channel for more curated knowledge shortcuts, and we'll catch you on the next deep dive.